Okay, welcome back everybody to the accounting. Um, Now we're going to be diving into chapter 4, which is going to be talking about the accounting cycle. So pretty much what the accounting cycle does is pretty much going to be our pretty much to-do list or check off list that we need to complete. Now, every step that we take, they do link to each other. So you need to complete one of the steps before you can get to the very last step. Now, of course, with that being said, we need to understand again what is accounting, and we talked about this before. But this time we're applying it through in a sense of applying it into how we put it into the accounting cycle. So again, it is a systematic method of how we ensure the accuracy of accounting by, again, our recording process, our analyzing, collecting, all those sorts of things that you need to have in order to complete the accounting cycle. So basically, putting our thoughts in order in some kind of systematic way that kind of flows in a pathway. So with that being said, there are a few characteristics of what we need to do for financial statements, but also like why we do it. Okay, so the very first one is we need to have our financial statements. They need to be reflected as reliable information. So this is where we're going to talk about, receiving source document. What makes it true, in a sense of what's our proof that we actually had a transaction? So making sure that our information is reliable, okay? Another thing is we want to make sure that it's relevant. Relevant meaning that when we're looking at the company at a specific time period, we want to make sure that all the information, such as, when we're dealing with cash, especially with cash, or some kind of credit, you want to make sure that you're reflecting the most recent and up-to-date current currency. So, for example, the US dollar, right? We know that it fluctuates every year or even every day, in matter of fact. So, when we're talking about relevance or being relevant, we want to make sure that it's in the correct time period. You don't want to record something that happened 10 years ago and then record something that is right now because of the difference between the times and the value of money, which we'll talk about in this class. So you want to make sure that everything is relevant, okay? So looking at a given time period, you want to make sure that everything is in its perfect within that time period. Other things that you want to do is you want to make sure that you're consistent. So when we actually talk about consistency, you're going to be looking at how certain rules apply, which today we would actually go ahead and look at a few accounting rules. And this, again, this consistency and all these rules that we must follow in order to do our accounting is going to be based off of us choosing a specific method and sticking to it all the way through. Okay? And we'll talk about, especially when we're dealing with the next section, which is going to be dealing with inventory, that when we choose a specific method, you can't just jump around and change methods whenever you want free nilly-willy. This is more like you have to establish which accounting method works best for your company. And if you do need to make a change for it, I believe you have to submit that information to the government. And I think you can only change it about maybe once or twice throughout your entire form of business. But for most cases, you want to be consistent with your type of information, because one thing that you're doing is when we're looking at our financial statements is you want to have you want to measure something. So what we will talk about measuring profitability. You want to have a consistent flow of information. And if you have one day you use this method, okay, so for example, I use cash method 1 month and then I use accrual basis next month, you're not going to have a true reflecting or information that you can compare very easily, because one's in completely different numbers and the other one is in completely different numbers. So you want to make sure that you are consistent with the rules and the methods that you choose in order for you to apply your accounting methods. And then lastly, you want to make sure that your information is comparable. Now, I'll talk very briefly about this, because when the main purpose and the main goal is when we produce our financial statements, not only are we producing it to our internal users, the real main goal is we want to make sure that our external users are, we want to impress them for them to want to invest in us. So when we talk about comparability, right, we want to make sure that we compare to someone else that's in the same exact industry or in the same exact kind of field. So if you're a mom and pop shop, we want to make sure that our financial statements look close enough or similar to someone else's books. Now, when we talk about comparability, right, we want to make sure that our financial statements look so good that a person would choose between 3 or 4 other companies. We want to make sure that it looks good enough for someone to want to invest, and especially if it looks consistent and it looks very comparable. Like for example, we have the profits. It shows you what your profit margins are. If you're able to produce something like that, you're more likely to be chosen, because you have a clear sense of easy to read material. So when we talk about comparability, we want to make sure that we're comparing ourselves to another company. All right. So again, the 4 characteristics of financial statements is going to be the 2 R's and the 2 C's: reliable, relevant, consistent, and comparable. Okay? Any questions in regards to this specific section? All right, so let's move right along. So here is what I was talking about, taking the definition of accounting and actually applying it in a uniform sequence. So I'm going to go ahead and talk about every single one of these steps in the next couple slides. However, I want to tell you guys this. By the end of this entire course, by the end of the 15 weeks, we should look at every single step from start to finish. So we're going to look at steps 1 through 10, okay? We're going to complete that all in 15 weeks. However, in the very first 10 weeks of our course, we're going to be actually just learning the first 3 steps, okay? So again, we talked a little briefly about the general ledger. When we introduce you to that, is going to be when we actually start our fictitious business, when we actually start looking at doing the books for Coffee Cafe. So steps 4 through 10 is going to be things that we will be learning in the very last 5 weeks of the course. So our main focus for now is to just focus on the first 3, but I'm going to go ahead and introduce every single step for you guys so you guys can have an idea of what's to come, but also how much it takes to complete an accounting cycle, okay? So step number 1, of course, is going to be collecting your source documents to verify your transaction. So we talked about transaction analysis, right? Yesterday, those 7 steps of transaction analysis also go kind of hand in hand with this accounting cycle. So the first step to the steps of a transaction analysis is to analyze the source document. Where's your proof that a transaction has occurred? and that is where we collect our source documents. So that could be anything from a receipt to an invoice to a checkbook to a bank statement, any of those things, contracts included. So any type of source of document. So we typically call this a paper trail. It's very, very good that you have a paper trail. Now I get it nowadays with the vast majority of online statements and stuff, it's still available to you. However, when we are doing this legitimate kind of business, you do want to have a physical copy and a digital copy, okay? So of proof that a transaction has occurred. So you want to make sure that you have your source documents before recording any transaction. That's the most important thing, is that you must have some proof of a transaction that it has occurred, okay? So that's the very first thing, is making sure that we have that, we collect that source document. So now we go move on to step number 2, is how to analyze and sort the information. So here I took an example, okay? So here's a receipt that I randomly created, and it's going to be a receipt. And this is what typically it would have. You would always have the company name, and what's going to have on the receipt is going to be the date. It's going to have the information of what items you purchased, and then of course it's going to have obviously the prices. It's going to include a subtotal, any discounts, any sales, or any taxes that you're being charged. And it's also going to enlist on how the method of how you paid for it. So again, we talked about that whole concept of understanding that the when, the what, the how, and the why. Okay. So again, this is a perfect example of a receipt. So what did we do? We bought office supplies. When did it happen? We have the date on the receipt right there. And then lastly, how did it happen? How did it happen kind of explains, well, first off, how did you pay for it? And in this case, I paid it with cash. So this whole thing is saying I'm acquiring supplies, which is an asset. And how am I paying for it? I'm paying for it with another asset, which is my cash. So that's how you take a source document and you're going to analyze it, and you're going to kind of figure out where you're going to place it into the information. And this is where, after we've analyzed it, right, this is where it branches out to the transaction analysis. We got to look up what accounts we're going to be using. We got to use the chart of accounts that exist in our company. Then we got to figure out the debits and credit system, and then we go ahead and figure out what book that it belongs into when we record this transaction. And then lastly, we're going to go ahead and journalize it. So that's step number 3, is actually recording it into our general journal. So again, here I have a piece of information, and this is what we're going to be looking at for the next 10 weeks, is practice journalizing and understanding how a transaction happens, and what are the necessary things that we need to do in order to journalize it. So here you go. We have office supplies. We paid cash for it. And here you go. We have the source document using the receipt, and we're going to attach this to the general journal. Okay. So there you go. Office supplies for the $61.09. Okay. Cash. All right. Then after we journalize it, the next step should be very, very crucial, because we want to always know what kind of balance we have in each account at a given time period. It is general rule of thumb that you should always try to update your general ledger at most times. Oftentimes it's done after the journal, or oftentimes it's done at the end of the day after you finish posting to your journal. So this kind of thing is that we have here is going to be the cash account, and here we also have the office supplies account. So as you can see, here we list all the transactions that currently happen. Now, especially if we're doing manual bookkeeping and we're not keeping track of our checking account itself, I feel that it's necessary that you try to update your cash or your checking ledger at all times, because one rule of thumb is you always want to make sure you have enough money in the first place in order to write your proper check out or to even go out and buy stuff and use your bank credit card. Always rule of thumb is you always want to make sure that you have the money before even doing a transaction. So, yes, so after the journal, you're going to post it to the ledger just like this, so you know what your account balances are at the end of a given period, whether it's the end of the day, end of the transaction, however it is, at least you know what your balance is. Okay? After posting to the ledger, you're going to complete a trial balance. Now, there's a couple trial balances that you will actually incur when going through the process of the accounting cycle. The first one is just to check to make sure that you have, that you have your debits equal your credits. Okay, so that's number one rule here. This is just so then it ensures that you accurately place your debits in the correct area as well as place your credits in the correct accounts. Now, oftentimes, these are usually, this happens at the end of doing a general ledger, because the ultimate goal is you're actually going to complete this right after the ledger, because you're taking the account balances from each ledger account. Okay, so here, the goal of this is to make sure that your debits and your credits match, but also it ensures the accuracy of your accounting. But general rule of thumb, when you create your trial balances, you're pretty much going to be listing every single account in your chart of accounts, or whichever accounts actually have existing balances in them. If you have certain accounts that have zero balance in them, it's you can list them out. It's not wrong to not do that, but again, it's you're just going to clutter your trial balance, and it's going to be a lot of information. So if you can try to minimize as much clutter, that's usually a general rule of thumb, is you don't include accounts that have zero balances in them. But other than that, we try to ensure that every single account is on there. So we do not list them in order. You can if you'd like, but usually it's easier to just do it in order from assets all the way to expenses. But that's exactly what you're doing. You're just listing them all out. It doesn't matter what category or what type they belong in. You just list every single account out with their respective account balances. So once we can prove that the trial balance, right, that our debits match our credits, then we can go ahead and safely assume that we can move on to the next step, okay? So once we reach the end of a given period, so we'll talk about establishing a period to schedule the accounting cycle. We'll establish that in the couple slides after this. But once we reach the end of a given period, we need to create adjustment entries. So, for example, right, when you buy office supplies, your assumption is you're going to be using them throughout your entire company. So therefore, we need to adjust what supplies have been used and what supplies have not been used to make sure that we update our office supplies account to reflect the value. Like what do we still have that holds value? So that's what we're going to call office supplies expense. Now, that's not the only thing that we're going to be limited to. We're going to be doing adjustments for when we dive into inventory. We're going to be looking at a periodic inventory, which is the very next section after this. Okay, so we'll look at periodic inventory. We'll look at depreciation. So we're going to talk about what happens when you use machinery, right? Obviously, if you buy a printer and you're using it, it's not going to hold its value anymore. You can't return it and expect to get 100% of your money back. You have to assume that because you used it, it's going to lose its value. And of course you used it. The machinery in it, it's getting worn out. The ink in it obviously is going to be not as much in there as it was before. So we're going to talk about depreciation and amortization, okay? So that's going to be in chapter 11, okay? Then we have supplies expense, we just talked about. We have a cost of materials, which we'll dive into in our fictitious business. And then lastly, another one that is a common adjustment is going to be when we adjust for bad debt expense. So this is going to be chapter 10. So all of this is going to be upcoming things that we will learn about. And again, this is a primary goal of mine is to teach you how and what to journalize and then piece it all together and everything will start making sense. So that is step number 6 is to complete your adjustment entries, okay? Once you've done that, you have to complete an unadjusted trial balance, okay? So oftentimes you'll be referred to many things such as unadjusted trial balance and adjusted trial balance. In this case, once we've completed our adjustments, that's when we can go ahead and do our adjustment trial balance. Okay, so don't get confused, but once we dive into doing the fictitious business, all of this will start making sense. So what happens is, of course, if we're making adjustments to our accounts, we need to also reflect that again by ensuring that when we do our trial balance again, that our proper our proper debits and our proper credits have been either removed or placed into another account accurately. Okay, so for example, when we looked at the supplies expense and the office supplies, you're going to notice that your account balance in office supplies is going to decrease, but however, you've placed it in office supplies expense for the $50. So again, you want to make sure that when you debit and when you credit your accounts, that when you do the adjustment trial balance, you want to ensure that you are placing the correct debits in the correct credits in their respective places. Okay. So once step 7 is complete, the next step is going to be creating your financial statements. So again, we talked about this in chapter 1, is introducing to you guys the financial statements. So yes, you are going to have to complete them. And what's crucial about the financial statements is they do go in a specific order, okay? So first off, it's going to be completing the income statement. So as we talked about what the income statement entails, it's going to be all of your revenues minus all of your expenses to get you either a net loss or a net profit, or net income, okay? Once we've established that number, the next thing is we can go ahead and create our statement of equity, okay? Because we have the choice here. We either pocket the profit or we reinvest it in our company. And again, general rule of thumb is if you are a small business, you should definitely reinvest your money back into your company because you're limited to many funds, but also it's also very crucial that you don't want to do bad business and just pull all the money out of your company. Then, you're not going to be able to be successful, especially if you owe a lot of money. So with that being said, so when you reinvest in your company, this is where if you have a net income or a net loss, it's going to either increase or decrease the value of your company, which we talked about, that is known as equity. So here we start off what we originally start off in our equity. Then we're going to either add or subtract our net income. And then we're going to either add any capital contributions or subtract any owner's withdrawal, which means you either add money to invest your own money into the company, or you're taking money out of your company. Once we figure that out, then you're going to get what's the ending balance, or the end of the period's new equity value. So in this case, because I'm reinvesting into my company, I've not only increased my equity by $309, so now my equity is now $2,309. So therefore, this makes my books look even better. It's making my company look more valuable, okay? So that is what happens when we complete the statement of equity. The very next statement that comes after that is going to be your balance sheet. Okay, so again, we talked about this. This reflects the very main core of all business, is to make sure that the accounting equation, it holds true. So this is where we're going to take all of our assets, we're going to tally them up, and we're going to reflect them against our total liabilities and our total equity. This equity number comes from your equity, the statement of equity. So that's why every single statement goes in a specific order. You need to complete the net income first in order to complete the equity, in order to complete the balance sheet by taking that new equity and combining it to the current the liabilities that hold in your company. So once we've actually made sure that our values, okay, so that our total assets equals our liabilities and equity, then we can go ahead and move on to the very, very last statement. Now, the very last statement is going to be the statement of cash flows. This one, you can actually complete after the income statement. However, because of how it goes, boom, 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 the flow of the flow of each statement, so one goes one after another, it's just easier to just do the last one very last, which is the statement of cash flows. Because the very most important thing is when we start the statement of cash flows is we do need our net income. And we also need to know in our balance sheet what our cash is at the beginning of the period and at the end of the period. So again, this is testing on how much money is actually coming into your company and how much money is actually coming out of your company. So that's the last statement that we're going to complete. And your main goal is to make sure that your ending balance in your cash is equal to the ending balance that you have in your balance sheet. Okay? So make sure, so that's kind of, I guess it is kind of something that you have to do after the trial balance, okay? So that is the 4 financial statements. When you go into more advanced accounting, that's where you're also going to complete the notes to the financial statements, where you disclose any and every single piece of information in regards to a transaction that can't be reflected in your reports. So that's going to be something that is going to be considered something that you continue on more advanced for. So I'm not going to focus on the notes to the financial statements. I just need to make sure that you guys understand this very main core thing. It's just completing the 4 financial statements as is. Okay. Then the next one, step number 9, is going to be closing out the books. So as I talked about this kind of briefly in chapter 2, we talked about our permanent accounts and we also talked about our temporary accounts. When we talk about this is where it ties into this section here in the accounting cycle, because again, when we choose at a given period, we choose to close out our accounts. And when we close out our accounts, we zero them out so then we can have some kind of projection or some kind of measurement to analyze profitability. So this is what I mean about closing out your accounts at the end of a given period. Because again, your sales are never going to be the same every week, every month, or whatever it is. And especially your expenses, they're never going to be the same except for maybe fixed expenses such as your rent. But you don't have just rent under your belt. You have other things such as office supplies expense, right? Maybe you used a lot of supplies this month versus the previous month. You might incur advertising expense. So your expenses can vary, okay? And that's exactly where we're going to talk about closing the books. So the first thing you want to do is you want to close your revenues into income summary. And then you're going to close all of your expenses into income summary. And then the very last thing is you're going to close out your income summary to your equity account. Now, this stuff will make more sense, but the income summary is actually going to be one of those things that you are actually going to learn in a private business, in a private company. If you learn this through corporate, another way to look at income summary is also known as your retained earnings. Okay, so they're words that you can just switch around. But however, for the sake of this company, I want to make sure that you guys understand that we are focusing on a smaller business. So in this case, we're using income summary, not retained earnings. Okay? So what we're going to notice is that at the end of the day, when we're looking at our income summary, you're going to notice that this number is going to equal your profit. Okay, and that's how you can verify and check your accuracy of completing the entire accounting cycle, is that things are going to line up and they're going to match each other. So if for any reason that your income summary does not match your income statement, then you're going to have to go back and figure out where you went wrong. Okay, but once you've for surely confirmed that the number of your income summary is equal to your income statement, that means you're good. You've done your good job. Okay, so of course, because this is involving with more transactions and more things that you're moving from one account to another, you need to complete the last but not least, the post-closing trial balance. So again, post-closing, after the closing process. So after you close your books, and the great thing is this should be a lot easier, because now all you're really verifying is obviously your assets, right? Or your debits should equal your credits, which is a list of all of your accounts, and your equity account, of course, is going to be summarized up, by going through the post-closing trial balance, since that's the last thing that we're going to be looking at. So again, we want to make sure that your equity is going to match your statement of equity, but also that your debits are going to equal your credits for one last time. And that is the accounting cycle. Okay? Any questions?
What's the difference between income statement and income summary?
So income summary is just an account. Income statement is actually a report. Okay, and we'll talk about this more in our fictitious business. So again, you're talking about, okay, so the income statement is a report. The income summary is just an account in your ledger. Okay, any other questions? Well, okay then. So again, we won't be learning steps 4 through 10 until the last 5 weeks of class. So it's not something you want to focus too much on. It's just something that you want to keep in the back of your head, that these things that are going to be your very last part of what you're going to be learning. But we are going to be learning the first 3 steps in the accounting cycle, and we're going to rinse and repeat them and understand all the types of accounts that you can utilize and how we utilize it. Okay? So the next one is going to be the accounting period. So this is actually very crucial because it does involve your accounting cycle. So what is the accounting period? It's basically when you want to schedule the accounting cycle to be completed. So again, you can do it every day, you could do it every week, you could do it every month, annually, semi-annually, quarterly. Common ones that you would normally see would be either a monthly or a quarterly or an annual financial statements or whatever it is. Typically, most companies are going to utilize those as perfect ways of measuring profitability. Reason being is because if you're doing it on the daily, you're not going to see a huge progression in regards to doing it on a monthly basis, where monthly, you have a lot more time, a lot more room to kind of see the change in your profitability. So that's a few things here. And again, common ones that you will normally see would be monthly or quarterly and then annually. And yes, but it doesn't mean that you're not limited to do daily. Now, think of perspective, for example, Walmart or Target. How many transactions are they dealing with in one day? And it's not just only one location. Think about all the locations in the United States. You can see how massive that is. So you can only imagine that the corporate, that's why they hire the big guys, the big accounting firms, to be able to create or do an audit trail or produce these financial statements either every monthly and every quarterly. I know for sure, major corporations, they release their financial statements. They do release them monthly, but to the public, they release it every quarterly. Okay, so having those big guys being able to produce these things, and it costs a lot of money because, again, how many transactions can happen in one day, and how many stores do they have just alone in the United States? And don't forget, they could have international stores as well. So you can only imagine what would fit best for them. And on this kind of type of business, daily is actually more beneficial for them, because you never want to wait too long to record all of your transactions. So think about it. If you're doing it every month, and let's say you average about 1 million transactions a day, multiply that by 30 days, you can only imagine how labor intensive it is to have to gather all the information, gather all the receipts, and be able to do this. Okay, so that's why we create these accounting softwares, so all of this could be done in a click of a button. But today, in this class, we're going to actually look at manual accounting, and we're going to see how labor intensive it is, and then move on to QuickBooks and see how much easier it is. Okay, so that's a little tangent there. So going back to this section here, now once you establish your accounting period, the next thing that you want to do is establish your accounting year. What this is basically based on when you want to file your taxes. So whether you want to file it calendar year, so from January to December, so usually it's when you establish this kind of one, it is generally within 12-month period, okay? Because especially when you file taxes, they never want you to file taxes every 5 years. It's every single year. So a perfect way for them to measure and to ensure that you're paying the proper taxes is you either file as calendar year, which is January all the way to December, or you file as a fiscal year, where it's any 12 consecutive months starting on the first day of the first month and ending on the last day of the 12th month, okay? And usually fiscal year is going to be based upon your core of your business. So if you are a swimsuit or bathing company, or a bathing suit company, so things like Billabong or things that sell summer things, you would typically be more busier in the summer. So by doing that, you are more likely to be on a calendar year because you'd be less busy over the winter, and that's the best time to file your taxes. Okay, so that's a calendar year example. But other businesses, such as if you sell Christmas trees, your biggest sales are going to be in the fall between, late October all the way to the beginning of January. So you're more busier during the winter time. So the best way to, file your taxes is you want to file it during your off season where, the spring or the summer, it's not very busy because there's no trees that are available. You're not going to sell a Christmas tree in the middle of July. So usually those kind of fiscal years, you can have it set for either the spring or in the summer. Okay, and that's an example of a fiscal year. Now, most government agencies are actually fiscal year starting July 1st and ends on June 30th. So that is something, just a little FYI, but pretty cool information if you like, So fiscal year versus calendar year. It's just based off on when you file your taxes, okay? It's not really truly having to do with your accounting period at all. But it does involve your accounting period because, again, if you're making lots of profits, the government wants to make sure that you file your proper taxes to the IRS, okay? So any questions in regards to the accounting period? Okay, moving on. Okay, so now I'm going to talk very, very in detail about the organization that pretty much governs everything that we do in accounting. So here is going to be the generally accepted accounting principles. So what is generally accepting accounting principles? It's a set of basic rules that governs every single transaction. So there are rules that we must follow in order to file our information, our statements, to properly display them or have them available for the public to see. Now, with these standard rules and procedures, you need to ensure, so these things, they help you ensure the accuracy of your accounting. So in other cases, in most cases, like a lot of this kind of stemmed out through Enron, right? Because they were able to do whatever they like to their financial statements, and it backfired because that's why the government is now more involved in, setting these standards and having every accountant follow through. Now, this is for all accounting, so even smaller businesses and corporate businesses must follow all these rules of GAAP. However, for smaller businesses, there's a lot of rules and a lot of guidelines that can be, can be lenient towards, because you are a small company. You might not have things that corporate companies may have. And also like other things such as if you're a small company, you can get away with a lot more because, that you don't have that much money, right? And you're just a small business. So with that being said, now we need to just understanding that there are there are 12 set of rules that you must follow, okay? Now, who invents these rules? It's going to be the FASB, okay? The Federal Accounting Standards Board, FASB for short, okay? They are the ones who actually get together, and they are the pretty much the ones that establish and create and modify these rules over time. And then of course, living in the United States, FASB, generally accepted accounting principle, they created these rules specifically for the United States only. So if you go to Canada, they have a slightly similar but a little bit a set of different rules. You go to Mexico, it's definitely going to be the similar but a little difference in between them. And especially if you go to Europe. And that is where you need to know that that's the difference between FASB, the GAAP, and the IFRS, which is also known as the International Reporting Standards, financial standards. The International Reporting Financial Standards. So that's the IFRS, okay? So you want to make sure that when you're dealing with others in other countries, they have their own set of rules on how they do accounting. So again, the International Accounting Standards Board is actually primarily geared towards Europe and a little bit of Asia, and I believe any other surrounding countries there. But again, it's based off in London, England, okay? And they pretty much govern a lot of the reporting standards that are, again, in Europe and partial of Asia, and other countries as well. So understanding this is that because we are in the United States, we are only teaching GAAP, okay? And that's why when you do your research for any projects or anything like that, you want to be very, very careful on which reporting standards they're using. Are they using the United States GAAP, or are they using the IFRS? Or if you go into overseas and you go to a different country, you want to make sure that their accounting standards that you apply their accounting standards. So again, that is exactly why in accounting, we have another area which is international accounting. You need to have somebody be able to learn and understand the international rules, so then they can go ahead and report to whoever and be able to be successful doing business out overseas. So that's just what I want to get away with here. And we're going to talk about all 12 rules and principles that GAAP has. Okay, so generally accepted accounting principles. Right? Any questions in regards to this? Okay. So first set of rules is going to be your assumptions. There are 4 assumptions that you need to know. First, I'm going to talk about one at a time. So the first assumption is going to be the business or economic entity. So what this definition entails is that when you're doing a business, you need to keep your personal and your business as separate, okay? Or in other senses, you need to keep track of your business and your personal transactions separate. So the best way to do this is, number one thing is to create your own business account. All right. Even though we are learning sole proprietor, yes, when you go to the bank and you're establishing yourself as the bank, your name's on that card. However, your business name is also on that card. So you want to make sure that you understand when you do create a business, a bank account, Not only are you the sole owner of that card per se, it's also your business credit card. So that's the best way in order to keep your transactions completely separate from your personal. And especially when you're looking at transferring money from your bank account to your personal bank account. Yes, you can do it, and that's the proper way to do it. You never want to pull out of your company's bank account and go spend it on something else, because technically that is you spending the business money. You didn't place it into your personal account in order to validate that it's a personal transaction. So there's a lot of rules and regulations to that, and we'll take a look at an example when we dive into our fictitious business. But the perfect example in order for you to keep your business and your personal transactions separate is to create a separate business bank account. Okay? Number 2 is going to be the going concern. Okay? Now, this one pretty much says that no matter if there's a foreseen, event, such as a foreclosure, right? If you can predict this, you're still going to continue doing business as usual. So, for example, Sears, right? We all know what Sears is. Sears was a huge, I would say, multi-product kind of service, actually not service, manufacturing and merchandising retail store. So we know that they sell anywhere from home appliances to furniture to clothing. Sears. When Sears claimed that they're filing for foreclosure and bankruptcy, and that they're going to shut down their business, they still continued doing business. They still sold off all of the items that they have in their inventory. They sold everything as usual, as if normal, but they only tacked on a discount, okay? But they still continued doing it until the day that they actually had to close their doors and no longer do business. So that is this concept here. Even if you have a foreseen event or a foreseen foreclosure, you are still going to continue doing business as usual, okay? So again, they continued completing their sales until their doors completely close off, okay? So that's the going concern there, okay? Then the next one is going to be monetary assumption. So this one's kind of broken down to 3, but they all kind of relate to one another. The first one is using some kind of monetary unit. So of course we live in the United States, so our monetary unit is going to be based off the U.S. dollar. Okay, so finding the most relevant form of currency. Now, if we're doing international trading or international business overseas, obviously we need to convert those money back into cash form, or the United States dollar form. Okay. Now, what I've also seen interesting as well too is nowadays cryptocurrency or Bitcoin, they're actually being used instead of the United States dollar. Now, again, of course, it's not widely used because it's actually very difficult to obtain a Bitcoin, but it is being used to trade. And there is a dollar value to it, right? If one Bitcoin is worth, is it 30,000 right now? Or something like that, 16,000? We still tack on a dollar value to it. So if we can do business and trade with Bitcoin, you can still translate it and convert it into the US dollar. So that is what a monetary unit is. And that also applies to being consistent. You want your reports to be all in one type of one type of currency. So if you are doing foreign trade convert it to the United States dollar. Or if you are planning to do overseas business, like completely shut down your business in the United States, then whatever form of foreign currency you're using, use that. So that's one thing that you want to make sure that you understand that. Of course, with that being tied in to monetary measurement, so again, we briefly talked about this earlier. Our journal entries, notice that when we buy quantity, we don't record it as the quantity. We record everything in terms of dollar. So that is exactly what monetary measurement does, is it takes a quantity and puts a value to it. So for example, if I have 25 employees, I'm not going to write 25 employees in my journal. I need to find some form of measurement that I'm going to place a value on. So if it's going to cost me a total of $100,000 for my total of 25 employees, that's what I'm going to record. I'm going to record that I have $100,000 worth in cost for my employees. So that's also one of the rules here, especially when journalizing. Everything is in terms of dollar value. Okay? And then lastly is going to be stable currency. So again, when we use our unit of the dollar, of course, we know that every year or every day the dollar does lose its value, or it changes its value. But the change is not super, it's not super noticeable. The dollar doesn't lose its value it doesn't lose much of its value in overnight. It's over a span of time. So what this little concept here is for stable currency is that because we are using the US dollar, it's backed up by the gold standard, okay? So therefore, our US dollar is a perfect form of currency that allows us to be able to, make projections. Because we know that the dollar is still going to be a dollar at the end of the day, compared to everywhere else. It's going to still hold a value of a dollar. So that's going to be considered something that we are going to be able to use as a stable currency, because it allows us to make projections in the future without the assumption of inflation, without the assumption of deflation or recession, we call it. So you want to make sure we'll want to make sure that because of doing during these time periods, us using the U.S. dollar pretty much allows us to make a rough projection of the future without having to take into consideration of inflation and anything that can change the dollar drastically. So that is all monetary assumption right there. Okay.
How about the digital currency?
Digital currency, you would have to convert it.
Yes.
Okay, so when we talked about cryptocurrency or Bitcoin, it does have a dollar value to it. Remember, if you remember earlier, I was talking about, we look at Bitcoin. One Bitcoin is roughly, I think it's 30,000 right now. We still tack on a dollar value to it. So if you do use cryptocurrency, you have to convert it when you reflect it in your reports, because that's also part of consistency. We want to make sure that our reports all are using the same form of currency. So whether it's using the US dollar or using Bitcoin. Okay, so yes. All right, last but not least is going to be the accounting period. So this is why the accounting period is so important. Because again, it allows us to be able to make projections or measure profitability, but however, it's also governed by GAAP. They require you to have an accounting period, and they allow you to break it up into smaller sizes. So, but the main rule is it has to be within a 12 consecutive months. Okay, but what GAAP allows you to do is you can measure either by day, daily, or weekly, monthly, quarterly, as long as you, as long as you're doing it within a consistent 12 consecutive months. So that's where the calendar year and the fiscal year comes into play. It's a consecutive 12 months. Okay, and they allow you to break up that year and allow you to create an accounting period, which is daily, weekly, monthly, semi-monthly, etc., etc. Any questions in regards to the assumptions? Okay. So the next one is going to be your basic principles. Now, this one's going to be the most widely used, and this is the one that's pretty much the one that you need to have at the back of your head at all times. Number one is going to be the historical cost principle. Now, when we talk about historical cost, this is pretty relevant because what the historical cost does is when you acquire either an asset or anything in general, so any expenses that you need to incur for your business. The general rule of thumb here is that the day that you buy it is going to be the historical cost, okay? And of course that makes sense because it's at fair value, it's at fair market value, right? For example, you buy land. If it's worth $100,000, that's the fair market value. You buy it at $100,000, boom. Now, the one rule that it does not allow you to do is recognizing a gain, okay? So what that means is you cannot just create money that comes from nowhere. So when you record a historical cost, let's say you bought that land for $100,000. 10 years later, it's supposed to be appraised for $200,000. But you cannot go in your books and say it's worth $200,000. Unfortunately, you cannot do that. That's considered impossible. You cannot create money out of thin air. So that's a whole $100,000 gain that you placed into your company. So that's what this principle is saying. Historical cost is going to reflect the day that you purchase the asset or whatever it is. The day that you purchase it is what you're going to record in your books, and it's going to stay that way until you sell that thing that you bought. So whether it's an asset. So again, if you bought that $100,000 land, 10 years later, it's now $200,000 and you sell it. Then if you sell it, then you're going to report that you sold it for the value that you originally bought it for. And then you're going to recognize what gain came out of it. Okay, so that's the proper way and the only way you should do this. And this is governed by, obviously, the government. So you want to make sure that when you make purchases of an asset or something like that, you record it at historical cost and it stays that way until you sell it. Okay? So and the only exceptions to that is going to obviously be inventory and money markets or, investments. So such as securities and stocks. Okay? Because those things have the purpose of, when we talk about inventory, which is the next chapter, we'll talk about the lower cost of market, and we're going to notice that when you purchase inventory, especially if let's say you bought machinery to sell, right? That's your primary inventory. You bought electronics, or for example, you're an electronics store. You cannot expect to sell that product years later in advance. So, for example, I recently bought the 2018 laptop. Okay, and I'm trying to sell it out. It's 2021. You have, technology, advanced technology. You have a slimmer look. You have a lightweight, compact laptop, or instead of using a disk now, it's a solid state drive. So there's going to be always progressions and the newer models. So you can't expect to sell a 2018 laptop for the same price as a 2021. It loses its value over time. And what you're going to do is, when we'll talk about this in chapter 6, actually, I'm sorry, what we do with that and how we adjust for that. So that's one of the only things that you can do when it comes to historical cost. Is, unfortunately, that's one thing that you have to recognize, whether you take a loss or you gain from it, is that you have to adjust your inventory because it loses its value over time. And in this kind of sense, you're actually unable to sell it for what you originally bought it for. So the second thing too is, of course, securities. You buy a bank bond for $100,000, and fast forward 20 years later, it's now worth $500,000. Yes, that's the only exception that you can go ahead and record as $500,000, because that's what bank securities are. It's the purpose of, trying to gain, or trying to, I don't know how to say it. It's the purpose of buying it is to intentionally gain a profit out of it. So that's probably the only two that I know for sure that are the exceptions to this historical cost rule. Okay. Any questions in regards to that? I kind of rambled on that one a lot, but any questions in regards to that one? Okay. Now the next two that we're going to be talking about is going to be the realization, or also known as revenue recognition, and matching principle. These two go hand in hand. Okay, so the revenue recognition, okay, so this is applied towards to an accrual type of business. So again, we recognize revenues when it's when the service or the product has been sold. So you actually recognize it and you actually report it as earned. Okay, so with that being said, matching principle is going to be, well, if you're going to recognize that you've earned a revenue, you need to have an equal expense that's correlated to your revenue. So that's the matching principle. There is that if you have any expense, they're going to be associated to every single revenue that is revolved in your core business. So again, when we talk about cost of goods sold, right, we know that that's what we originally purchased our product for. But what we're going to do is we're going to also consider, well, what about the cost it takes to operate the business? So things like that. So, and then also cost for materials to produce that product. You know what I mean? So revenue recognition, saying all expenses are associated to every single revenue that you've earned. Okay. And then lastly, adequate disclosure. So this is what I was talking to you guys about when it comes to the notes to the financial statements. So again, for any reason you have information that is pertinent to a transaction, but you can't journalize it, there is an actual special place that you do place it. So the example I used earlier was when I talked about having the 25 employees. you know, your 25 employees can consist of a lot of things, okay? Even though when you journalize it, you can only journalize it as a dollar value, how much it costs you to have those 25 employees. What you're going to do with the notes to the financial statement is that's where this concept comes in. That's where you're going to disclose all the information. So, of course, in this kind of case, you're going to disclose that, okay, your 25 employees, they could either be salary based or wage based, okay? And obviously, you're not going to disclose their information, but you could say that X amount is going to be my salary based people, and then X amount are my wage based people. And then other things that you could do is you could break down your salaries. So, for example, positions that these people are. So, oftentimes, if you've ever looked at an actual company's financial reports, it's always like a cover page of their company, what the company does, and then the next page is going to be a list of all the people that run the business. So the CEO, the CFO, the vice president, the president, the president of the treasurer, things like that. So you're going to get a list of all those, and then typically that would kind of also disclose, that these people are going to be your salary-based people, okay? So that is going to be things that you want to place in there. Other things too is like if you have a credit card company that you borrowed, or a bank loan, for example, you borrowed a bank loan. You can't, you could disclose that in your journal, but the best place to put it is going to be obviously going to be in your notes in your financial statement saying, okay, well, here, the reason why I have a loan, or how many loans I have, what interest rate they are at, et cetera, et cetera. So that's the place that you can disclose all that information in, and that's adequate disclosure. So any questions in basic principles? So these are the things that you need to be aware of in regards to journalizing, okay? Any questions? No? Okay, so it is 9:45, I believe. So I'm gonna it's okay. So I'm gonna go ahead and call break here. So I'm gonna round it up to I'm gonna give you 20 minutes. So 9:45. So please be back no later than 10:10. I mean, sorry, 10:05. So I'm gonna call break here, and I'll see you guys in a bit.
Thank you.